Index funds, in my opinion, are the best, relatively safe and passive way to invest your money. Index funds outperform individual investors 99% of the time, and they outperform hedge funds 85% of the time. Index funds are my bread and butter investment strategy, and I'm going to walk you through exactly what you need to know to invest in index funds. Before we do, let's pay homage to the index funds by smashing the like button. It helps the channel grow. So what is an index fund? An index fund is a way for you to have a piece of many different companies. It's a portfolio of stocks or bonds that follows the performance of the market. Let's take an index fund that follows the S&P 500. The index is the 500 biggest companies in the US. And if you buy into this fund, you now own a piece of all 500 companies. Now let's talk benefits. The benefits include there's low expenses and fees. Very low. Fees are the killers of investments. This is so true that the Financial Research Corporation did a study to determine which of the 11 common predictors of mutual fund performance actually work, and they found that the only reliable predictor of performance for mutual funds was low expense ratios. The reason index funds have lower expenses or fees is because they are passively managed and not actively managed. There isn't a person managing the fund inside. They're actively trading and swapping stocks left and right. With index funds, stocks are purchased automatically to follow an index. And the benefit of these lower fees is that the money that you invest in, more of it is gonna come back to you rather than it going to fees. And those fees are typically going straight to the person that's managing the fund. The next benefit of an index fund is that it's difficult for them to underperform. The goal of an index fund is for it to match the risk in return of the market, because that will usually outperform any single investment you could make, as I've stated. It's also difficult to underperform because when you buy into an index fund, you essentially just kind of bought the entire market. And since you just bought the entire market, you're almost guaranteeing yourself market growth with minimal volatility. Let's take the same index fund that follows the S&P 500, for example. The index is the 500 biggest US companies. If 2 of these companies go down in price, there's still 498 others that are going up, which brings me to my next benefit of diversification. People say to me all the time, oh man, I wish I had a diverse stock portfolio. So I bought a little bit of Apple and then I bought a little bit of Walmart. Why not just buy into a fund that you would own all 500 of the largest companies? How diverse is that? Index funds are innately diverse, and that reduces risk. Quick recap on index funds so far. They get to as close as possible to matching the market because they are essentially make up the market. They're passively managed. There's not a person in there trading stocks left and right for you. And they have low fees and expense ratios because they're passively managed. So why are index funds a good investment? And why haven't you hit the like button? Please do that right now. Please. Since 1900, the S&P 500 has had a 198% return by decade and about a 10% average return per year. So it's safe to assume investing inside of an index fund that follows the S&P 500 is not a bad move. Additionally, when you buy an index fund, you buy with the mindset of buying it and holding it for as long as you can. Let compound growth do its thing, baby. Bringing me to my next point, that it's more important to have time in the market than trying to time the market. Reason being is because it's impossible to time the market. Everybody's concerned about, oh, what if I buy right now? Is it too high? Should I buy a bunch because it's low right now and I gotta get in? I'll just wait till it gets a little bit lower. It's impossible to know what the future is gonna hold, safe to assume. But if you buy now and we rely on the history of the S&P 500 that it's grown 10% year by year, and you buy when it's high, buy when it's low, buy as much as you can, and you hold for as long as you can, your compound growth is going to do the talking. I almost think of it as riding a wave. You're buying at the top, you're buying at the bottom. Overall, you're buying as much as you can. Another reason to jump into index funds outside of its history of growth is because it's an easy way to invest. Choose an index fund either through Vanguard or Fidelity. I use Vanguard, and you set up automatic investments. If you put in $200 every single month into an index fund that follows the S&P 500 and it has a 10% return, when you pull it out in 40 years, you will be a millionaire. The most difficult aspect of index fund investing is just setting up your account, and that only takes a handful of minutes. Let's discuss how to analyze an index fund. Let's go to Morningstar.com. It's the one-stop shop for mutual fund analysis. Here's the expense ratio. Win or lose, the manager of this fund will get this amount. They get X% every single year, and it has a huge impact. Turnover, this is what percentage of stocks they'd sell and trade out of their portfolio every year. The plus minus index is how it is performing relative to the market. Front load is a fee to invest. If you invested $1,000 and the front load fee was 5%, they take $50 right off the top. Redemption load is the opposite. It's when you sell it and they take money from you. Deferred load, if you decide to hold it for less than a certain amount of time, they'll charge you a fee. Portfolio is what's inside the fund. Value is underpriced companies, and growth is aggressively growing companies. Let's move on to investment strategies. There are 3 strategies that I'm going to cover. If you are closer to retirement, you'd want a more conservative investment strategy. While if you are younger and have many years before you're gonna retire, talking decades, you're gonna want a more aggressive investment strategy. One of the most popular investing strategies is the 3-fund portfolio, meaning you have percentage of a US stock index, an international stock index, and bonds. With the 3-fund portfolio, you rebalance your assets and reallocate your funds based on how close you are to retirement. If you're a young buck, you could have anywhere from 60 to 80% in the US index and then 10% of bonds and the remaining in international stocks. Then when you're approaching retirement, you could reallocate those funds to be about 70% bonds, 20% US stocks, and 10% international stocks. The pros of the 3-fund portfolio strategy is that it's simple, well diversified, and customizable. In addition to, it's flexible because there are a lot of different funds you could choose from. Anyone can do it. The cons for the 3-fund portfolio are that it requires asset allocation decision making and may require rebalancing and reallocating your funds. Although rebalancing doesn't have to be too hard, you can merely invest more toward one than the other and stop investing in the others if you want to amp up your percentage in one. So I wouldn't be intimidated by that. I feel like that would take a handful of minutes out of your entire year to do. Actual examples of a 3-fund portfolio would be VT-SAX for your US index, VTIAX for your international, and VBTLX for your bonds. That's if you're investing through Vanguard. If you're investing with Fidelity, it could be FZROX, FZILX, FXNAX. If you're investing with Schwab, here's some ETFs, SCHB, SCHF, SCHZ. Those are all examples of 3-fund portfolios. Another way to accomplish the 3-fund portfolio with one single fund is a target date index retirement fund. Target date index funds are dope because it's an all-in-one package that does all of the work for you. They have US index inside of them. They have international index inside of them. They got bonds inside of them. It's an all-in-one package, baby. And they reallocate for you. They do all the rebalancing. When you first start out, they usually have 54% in the US stock index, and they got 36 in the international index, and then they got bonds for the remaining portion of it. And target date index funds are all named after the year that you want to retire. So if you want to retire in 2050, it's gonna change your allocation based on how close you are to retirement. So it's gonna start out aggressive, and then somewhere over time, it's gonna start leaning into a more conservative asset allocation. And by the end of it, it's gonna be predominantly bonds. I will include a link in the description to the target date glide path that'll show you exactly how many years out it automatically rebalances for you. I got a photo of it right here, and it looks like if you're 45 years away from retirement, you're gonna be predominantly in stocks, about 80%, including US and international, with 10 to 20% in bonds. And then by the time you're 25 years away, it starts to reallocate a little more to get a little more conservative. It's nice. The only downside of these target date index funds is they have a tendency to be a little too conservative. That's not a very big deal because you could just choose a target date retirement fund that's even further so you can have the aggressive portion for longer. But those are super dope if you're like, I just want one fund for the rest of my life that's going to do everything that I need. Target date index funds will do just that. Lastly, the third investment strategy is what my current portfolio looks like. I like to think that my portfolio is fairly diversified, and here's what it's looking like. I got 25% in an international index fund. I got 25% in a small cap fund. I got 25% in a mid cap fund, and then I got 25% in a large cap fund. I'm a young man with an aggressive portfolio, no bonds for me. Each of these 3 strategies, from the 3-fund portfolio to the target date index funds to my 25, 25, 25, 25, the main thing here is you're gonna buy, and hold as long as you possibly can. We're talking decades. If you want to get started in index fund investing, I recommend that you open a Roth IRA, buy an index fund inside of that Roth IRA, max it out every year, and once you've maxed it out, open a brokerage account and then just start pounding your index funds with everything remaining after you've maxed out your Roth IRA. To recap, hit the like button, subscribe, comment something about index funds. Index funds are passively managed, which means lower expense ratios. Low expense ratios are crucial to making you dough, because if you have a 2% expense ratio, if you take 2% off of your investments every single year, it's going to be hundreds of thousands of dollars by the time you're ready to pull it all out and use it. You want your index fund to follow the performance of the market, which is what they were designed and built to do. When you invest in an index fund, you're getting a piece of a bunch of different companies. The absolute simplest way is to invest in a target date index fund, and it'll do all the rebalancing and asset allocation for you to one-stop shop. Comment below if you're going to get started in index fund investing, like, subscribe, and I'll see you in the next one.